All right. So we are going to do a question of the final accounts, and this is a question number two of this section, final account section. So question number 352, and the name of the question is the price well. Let's look at the requirement first, and the requirement is going to be the same because this is final account. So prepare the statement of the profit or loss and other comprehensive income for the year ended 31st March 2009. So dates are very important. You should know that which year ended financials are being prepared, and prepare the statement of financial position. So 10 marks for statement of profit or loss and 10 marks for the statement of financial position. And they have said that the statement of change in equity and notes to the financial statements are not required. Sorry for my cough, and the season is this way going on, and because of the winters. Okay. Anyways, whenever you're doing the question of the final accounts, the first thing you need to see is the trial balance. So the following trial balance relates to the price well 31st March 20x9. This is the debit side and this is the credit side. So this is the debit side of the trial balance and the other side is the credit side. Leasehold property at valuation 31st March 20x8. Valuation means the carrying value, and this is the start of the year because the year end is 31st March 2009. So this is the opening balance. Plant and equipment at cost, which is 46,800. Right of use assets, which is the leased asset. Cost is 20,000. And the accumulated depreciation of the owned plant is 12,800 and right of use plant is 5,000. So why we have not been given the accumulated depreciation of leasehold property? Because already the carrying value is given. Carrying value is cost minus accumulated depreciation. Then you have the lease payment, 6,000. Then you have the lease obligations, the opening balance, 15,600. Then you have the contract with customers, which is IFRS 15. Inventory, which is the closing inventory. Trade receivables, closing, bank on the debit side, so this means it is current asset. Trade payables is your current liability. Revenue, there is a note number 3 for it, 3,10,000. Cost of sales is 2,34,500. Distribution cost 19,500. Administrative expenses, equity dividend paid, which is reduction in the retained earnings. So we'll treat this from the retained earnings. And then you have the share capital, 40,000. So 40,000 is the amount, this is in dollar, and each share worth 50 cents. So how many shares? So number of shares will be 40,000 into 2. So number of shares will be 80,000. So 80,000 shares. And remember, this 40,000 represents the balance. Retained earnings is 44,100. Current tax is given on the debit side, so it's under provision, which increases the current year tax charge. Deferred tax is the opening balance of the deferred tax, which is 8,400. So first of all, you have to read the trial balance carefully. Okay, then you have the notes. So note number 1, non-current asset. The 15-year leasehold property was acquired on 1st April 20x7. Now, our year end is 31st March 20x9. So that means this asset was purchased 2 years back at a cost of 30 million. The accounting policy is to revalue the property at fair value at each year end. The valuation in the trial balance of 25.2 million as at 31st March 20x8 led to an impairment charge of 2.8 million. which was reported in the statement of profit and loss under the comprehensive income in the year ended 31st March 2008. So in the last year, they had an impairment of 2.8 million, which they reported in the last year. This was the last year impairment. As I said, it is very important to see the dates. And in the trial balance currently, the opening balance, the carrying value is 25.2 million. This asset was purchased 2 years back. After 1 year, it was being assessed for the impairment, and then the value is 25,200. So 1 year has been passed. The total life was 15 years. That means now at this date, it should be depreciated over 14 years, because once we do the revaluation or the impairment, then depreciation is charged on the revalued amount and the remaining useful life. So the remaining useful life is now 14 years at the start of this year. And then at 31st March 2009, the property was valued at 24.9 million. So again, it was being revalued. And now we'll see whether it is having again the impairment or the gain. Owned plant is depreciated at 25% reducing balance method. So in the reducing balance method, we charge the depreciation to the carrying value. The right of use plant was acquired on 1st April 2007. 1st April, again 2 years back. The rentals are 6 million per annum for 4 years. So the lease is for 4 years in arrears. That means not in advance. The interest rate implicit is 8% per annum. The right of use plant is depreciated of the lease period, which is 4 years. No depreciation has been charged on any non-current asset. All depreciation should be charged to the cost of sales. That means whatever we calculate should be allocated to the cost of sales. So far, we have seen that there are three assets: leasehold property, plant and equipment, and right of use assets. So, we can just make the PPE schedule. Remember that whenever you are doing this thing on the Excel, that means just putting these figures in the cells where in the cells. That means when you have the Excel sheet, spreadsheet, you have the cells. So you have to put these on the cells. And then there are simple formulas, addition, subtraction. I'll put a video explaining a question on the Excel as well, but in the live class it is not going to be possible because I have to see so many things. So PPE schedule, and then you have the leasehold. Okay, let's go back again. Leasehold property. All right, you have owned plant and equipment. And then you have right of use. So first of all, we are going to take the cost and then accumulated depreciation, and then it is going to give us the carrying value. So already the leasehold property, we have the carrying value, which is 25,200. Plant and equipment, the cost was 46,800. And the accumulated depreciation was 12,800. The right of use was having the cost of 20,000. And the accumulated depreciation was 5,000. All right, so now we can use the calculator. Obviously, when you are doing in the Excel, there is no need of the calculator over there. 34,000, and this give you 15,000. And now we'll be calculating depreciation for the year. So depreciation for the year is 25,200 divided by 14. It gives you 1,800. And then 34,000, it was 25% reducing balance method. So 34,000 into 25%, it gives you 8,500. And then leasehold property was 4 years. So 20,000 divided by 4, it gives you 5,000. So that means the carrying value we get at year end, 25,200 minus 1,800, 23,400, and then the other one, 34,000 minus 8,500, it gives you 25,500, and this gives you 10,000. Okay, then the asset was revalued, the leasehold property was revalued at the year end, and it was 24,900. So it was the only property which was revalued, only PPE. So revalued amount was 24,900. That means it has gained the value. So how much gain? 24,900 minus 23,400. There's a gain of 1,500. Now, why they gave you this point that in the last year they have charged the impairment? They gave you this point because remember the reversal of impairment in the IS 36. So the asset was previously impaired and now it has gained the value. So this reversal of impairment, that means it should be where should be the entry, debit asset by 1,500 and credit profit or loss by 1,500. It should not be recorded in the revaluation surplus because first of all we have to reverse the impairment. So $1,500 impairment should be reversed and credited to the profit or loss. So you can allocate it to the cost of sales. All right. So we have done this working. Okay, now what was the depreciation charge? So depreciation we have calculated is 1,800, 8,500 and 5,000, which we'll be calculating later on. All right, and then you have the right of use plant. Okay, we have calculated the depreciation, but now we'll do the lease obligations working. Lease obligations. So we have 31st March 20x9. So first of all, remember opening balance of the lease obligations. Go to the trial balance and see what is the opening balance. Lease obligation. It is lease liability. It's 15,600. And what was the lease payment every year? It was 6,000. And what was the implicit rate of return? It was 8%. So it becomes quite easier. The amount was 15,600. Yeah. So 15,600, and then you add interest into it because it's the lease payment in arrears. So 15,600 into 8%. All right, again, let's use the calculator. 15,600 into 8%. It gives you 1248, which is your finance cost. And then you less the payment, which is fixed, 6,000. It gives you the closing balance. So plus 15,600 minus 6,000. It gives you 10848. As you know, we have to do 1 year extra working in order to split the liability between current and non-current. So 10848, and again 8%. It gives you 868, and then again 6,000. You can check calculation yourself as well. Sometimes, you know, there is a mistake. So make sure you have the calculator as well. 10848 plus 868 and minus 6,000. So it's 5716. Now we can have the extracts. So finance cost is 1248, and what's the other one? Non-current liability is 5716, and the current liability is 10848 minus 5716. 10848. It's 5132. All right. So we have done the lease working as well. Okay, now let's move to the other working. This is the revenue, IFRS 15, revenue from contracts with customers. On 1st October 2008, Pricewell entered into a contract to construct a bridge over a river. The performance obligation will be satisfied over the time. Agreed price is 50 million, and construction was expected to be completed 30th September, which means in 2 year time. In 2 year time. Okay, so material, labor, and overheads. Specialist plant acquired. Payment, which is the billed amount. The sales value of the work done has been agreed to 22 million, which is the work certified. And the estimated cost to complete, excluding the plant, is 10 million. The specialist plant will have no residual value at the end of the contract and should be depreciated on a monthly basis. Okay, so that means it should be depreciated over 2 year time. Okay, so Pricewell, recognizing progress towards satisfaction of the performance obligation on the output basis as determined by agreed work to date compared to the total price, which means work certified by that. All right. So now we did so many questions in the practice. Now you can, just uh, calculate, write the steps. Okay. So revenue from contracts with customer. So step number one, whether the contract makes the profit or loss. So contract price less cost. Now, see, the cost to date is 12,000. The further cost is 10 million. And the plant is acquired specially for the construction. So this is your cost as well because it will be depreciated over 2 years and has no residual value. So 12,000 cost to date. Further cost is 10,000 and 8,000 is the plant. So contract price was 50,000. Now the total cost is 10, 12, 22 and 30. So 20,000 is the profit. All right. So profit should be recorded based on the stage of completion. Loss should be immediately recognized. Now the step number two, stage of completion. Work certified divide by price into 100. So work certified is 22 million, 22,000 divided by 50,000 into 100. So 22,000 divided by 50,000 into 100, 44%. All right, now you can calculate the step number three. So revenue is how much? 50,000 into 44%. 22,000, which was already given as well. Profit 20,000 into 44%. 8,800. So cost can be calculated as a balancing figure. 13,200, which goes to the cost of sales. This goes to the revenue. Step number four. Statement of financial position. This was statement of profit or loss. Cost to date. Cost to date was 12,000 and they said excluding depreciation. Sorry, cost to date was 12,000. And now you need to calculate the depreciation as well. But we have another asset over here, which is plant, specialist plant. So the cost was 8,000. Till here there was no depreciation, so 8,000. and then the depreciation was 8,000. It was bought for 2 years, and when they entered into the contract on 1st October, so 6 months till March. So 8 divided by 2, 4, and 6, 2,000. So that means this will be recorded in 6,000. So 12,000 is the cost to date plus 2,000 depreciation. So the total cost related to project becomes 14,000. Profit to date is we have calculated 8,800. Billed amount was given in the question 5,700. Now we can calculate whether they have the contract asset or what. 14,000 plus 8,800 minus 5,700. 17,100 in positive, so which means it's the contract asset. Should be recorded in the statement of financial position. Okay, now we are done with this. Pricewell revenue includes 8 million for goods sold acting as an agent, and you know that revenue is only the income from the ordinary course of business, and it does not include agency commissions and things like that. Pricewell earned a commission of 20% on these sales and remitted the difference of 6.4 million to the Tilby. Okay, Pricewell earned a commission of 20% on these sales and remitted the difference of 6.4 million included in the cost of sales. Fine. So revenue adjustment. So they have included this in the revenue. So first of all, we have to de-recognize from the revenue. And what is the amount? Okay, 8 million into 20%. That means they have recorded 8,000 in the revenue. It should be de-recognized. Okay. And they have recorded in the cost of sales 6,400. So it should be de-recognized from the cost of sales as well. Okay, now credit other income, which is their commission of 1,600. So de-recognized from the sales, de-recognized from the cost of sales, and recorded in the other income. And the last working. The directors have estimated the provision for income tax. Okay, and is this the required deferred taxation? Is this all adjustment to be taken in the statement of profit or loss? And that's fine, it's easy adjustment. Taxation. Already you did it when we were doing IS 12. So it's the tax provision, which is the current year tax, 4,500. And remember there was an under provision which increases the tax charge. How much was that? 700. All right, so the opening deferred tax Opening deferred tax was 8400, if I correctly remember, yes. And the closing deferred tax is 5.6, 5600. So it's a decrease. 8400 minus 5600. It is a decrease of 2800. So decrease in the deferred tax is the reduction in the expenses, 2800. So what figure goes to the profit or loss? 4500 plus 700 minus 2800. 2400 goes to the profit or loss. All right, now we are done with all the workings and we can prepare the financials. So the statement of profit or loss. So first of all, we have the revenue. Okay, let's go to the trial balance and see how much revenue we have. It's 3,10,000. But in this 3,10,000, we are supposed to add the 22,000 which was on the construction contract, and we have to reverse how much from it? 8,000 from this. All right, so it's 3,10,000 plus 22,000 minus 8,000. It gives you 3,24,000. Okay, then you have the cost of sales. It's better to do a working for the cost of sales. Let's do over here. Cost of sales. Okay, as per trial balance, as per trial balance. Where is the cost of sales? This one. 2,34,500. Then you add the depreciation. So again, you have to go back and see how much depreciation you have. How much depreciation you have. So we're gonna take these three: 1,800, 8,500, and 5,000. Why we are not taking the other one? Because we'll take directly the cost of sales of the construction contract, which includes the depreciation as well. So 1,800 plus 8,500 plus 5,000. So 1,800 plus 8,500 plus 5,000. It's 15,300. 15,000. So we are allocating it, so that means positive. Okay, that means, okay, now we have to allocate the cost of sales of the construction contract. Again, you have to see the working, how much was it? Step number 3. So the balancing figure, it was 13,200. And then we need to reverse the agency, which was 6400, and then there was a reversal of impairment. It was 1500. Okay, now you can calculate it. So 234,500 plus 15,300 plus 13,200 minus 6,400 minus 1,500. It's 2,55,100 net amount. So we put here 255,100. It gives you the gross profit. All right, minus 324,000. 68,900. Okay, then you have administration, you have distribution, you have other income. So administration, directly go to the trial balance and see 27,500, and distribution is 19,500. So 27,500 and 19,500. Other income was 8,000 to 20%, 1,600. Then you have the finance cost, which we calculated from the working 1248. It was 1248 from the lease. Yes, where it is? Where's lease working? Yeah, it was 1248. So it's the finance cost. Then you get PBT, profit before tax. Again, calculator. So 68,900 minus 27,500 minus 19,500 plus 1,600 minus 1248. It gives you 22,252, and then you got the tax from the working of the taxation. How much it was? 2,400. So profit for the year, as we have no other comprehensive income, minus 2,400. 19,852 is the profit for the year. Now you have the statement of financial position. Okay, first of all, you have the non-current assets and the non-current assets. In the non-current asset, you are having the PPE. Again, we're gonna go back over here and let's total it over here. 23,400. No, it's 24,900. 24,900 plus 25,500 plus 10,000 plus 6,000. 66,400. 66,400. Okay, then you have the current assets, inventory, trade receivables, bank. Inventory, where it is 28,200. Trade receivables, 33,100. Bank, 5,500. And then we were having the contract asset, 17,100. You get the total assets. It's a good thing in the Excel that there's no need to use a calculator. So 28,200 plus 33,100 plus 5,500 plus 17,100. So 150,300. Okay, then you have equity and liabilities. So first of all, you have the equity, which was given in the trial balance of 40,000. Then you have the retained earnings, and retained earnings as per trial balance is 44,100. You add the profit in it, which was 19,852 profit for the year, and the dividend was 8,000. So it gives you 44,100 plus 19,852 minus 8,000. 55,592. 952. It gives you total equity of 95,952. Okay, then you have the non-current liabilities, in which you have two: deferred tax and lease obligation, lease liability. Don't write DT and LL in the exam. It's just what I am writing to save the time. Deferred tax was 5,600. And the lease liability, which we distributed between current and non-current. Non-current was 5,716 and other one is 5,132. So 5,716. Okay, then you have the current liabilities. So you have the trade payable, you have the lease liabilities, you have the tax. Trade payables in the trial balance, 33,400. Lease liability was 5,716, 5,130. Let me check. 5,1, where it is? 5,132, sorry. 5,132, and the tax was 4,500. Now you have the total of the equity and liabilities. Okay, it's 95952 plus 5600 plus 5716 plus 33,400 plus 5132 plus 4500. It's 150300. Is it matching with the total assets? Absolutely yes. So this is your complete question with all of the workings, and the name of the question is Pricewell.